Hello, everybody. Welcome to Spinnaker Investment Group's quarterly review. This is for the end of quarter two. So we're going to review what happened in the quarter, some of our thoughts going forward. This is going to be a little bit different than in the past. We're not live. We're not on Zoom. We're going to record this, so no live call-ins. However, we will go through a lot of the things we do on our other quarterly reviews, although it'll be a bit shorter. So let's start. So good quarter, right? We look at the S&P 500. Up about 8.5%. Small companies, those little guys, were off. They weren't off, but they didn't do quite as well, up 4.3%. So those smaller cap companies represented by the Russell 2000. And that's somewhat expected because as you come out of a recession, first quarter this year, those stocks did quite well. They tend to lead out, and while they did fine, they didn't do quite as well as the broader S&P 500. Then we had emerging markets. We had international developed. So even international stocks and emerging market stocks had a good first or second quarter, followed by bonds. That we had the first quarter with interest rates that went up, bond values went down, and that reversed a bit. Rates came back down. In fact, as of today, rates were on a 10-year were about back down to 1.3%. Inflation protected bonds were up, high yield bonds up, international developed market bonds, and even commodities. We saw a spike there, and we'll get into that a bit more as to why. Certainly some areas like precious metals went up, but we also had commodities like lumber and various things like that, copper that spiked. And then real estate investment trusts, after an abysmal 2020, continue to do quite well. So looking at the overall world-class assets, as you look at it in a chart basis here, U.S. REITs led worldwide. So U.S. real estate investment trusts, apartments, hospitals, hotels, and all that, they led the charge, followed by smaller emerging market type stocks, which is interesting. So it looks like people are comfortable taking on risk, as those were the second place area, emerging markets. Then the S&P 500, larger cap Russell 1000, and then the broad market 3000. And then you look at the bottom, Treasury bills, very short term, we're at a 0% essentially. Even regular bonds were higher than that. Now let's break it down to U.S. What did well in the U.S.? Well, we saw a rotation. We saw the first quarter where value stocks did a bit better, and now we're at a rotation to growth. So some of the technology stocks, we went less from that opening up, back to the trade to technology stocks. So growth led, it outperformed the just large cap in general and large cap value by basically double, and doing quite better even than both small value and small cap growth. Then you look here in the period returns year to date, large growth is leading. Not leading. It is still under, but it's still at 12.99% with the value at about 17%. So we did see a push there, but you start looking at the 1 year, 3 year, and 5 year, and certainly growth has had a heck of a run. We'll probably continue to see value catch a bid, but growth is starting to move a bit higher, and so maybe there's some room left in that. But we did like what we're seeing in the first quarter, and we'll still see it into the second quarter, and that is some of those value stocks being purchased. International developed, much of the same story, growth led, not much of an impact by inflation as you see in the lighter and darker gray areas there. So growth led with value at the bottom. Year-to-date numbers look pretty good on the value side in international stocks. So again, some of the same trends. I think where we'll see the trend change a bit is in emerging markets, as that quarter saw nice growth in those smaller companies. So small emerging market companies, people taking that risk, value being second, people wanting that risk. So we were certainly seeing a risk appetite in the emerging markets. Year to date, both small cap value and just small cap in general and value doing quite well, with their 1 year numbers actually quite impressive. We're seeing some turbulence a bit in the emerging markets as China has cracked down on some of their technology stocks, and so we'll see how that plays out in this quarter. Now, different markets. So when we look at developed markets, we had on the developed international markets, Denmark, Switzerland, and Finland at the top, with New Zealand, Japan, and Singapore at the bottom. The emerging markets, somewhat of a reversal because we saw oil move up a bit, but you had Brazil, Poland, and Hungary at the top, with Chile, Peru, and Egypt towards the bottom. Real estate investment trust, spoke about this earlier. U.S. REITs led over their global counterparts, and finally this sector, after having a pretty tough 2020, has done quite well. Year to date, up almost 23%. The 1 year, 3 year, and 5 years also looking a lot better than they did last year. So good diversifier. If you believe in inflation, this is certainly an area that we would suggest looking at. Commodities, so we did see commodities again catch a bid here. We look at the quarter up 13%, and this is a basket of different commodities. So at the top, soybean oil, natural gas, coffee, and at the bottom, soybean meal, cattle, and hogs. But we're still negative on the 10 years. So per annum, you would have lost 4.44% because it's been a while since we've seen commodities move up. But they're certainly staging a decent comeback. And, part of that is, is it because people believe inflation, or people are finally buying into these areas? Is it because Bitcoin's going down? You track Bitcoin versus gold, and as Bitcoin has gone up, gold has gone down. Now as Bitcoin has moved down, we've seen gold move up. So there may be a lot of different reasons, but certainly the commodities area is catching a bid. Fixed income, we had a little bit of a move there. Certainly from a year ago, 6/30/2020, we've moved up. The whole line moved up to that green area there, but very little change from last quarter to this quarter. We did come back down a bit, and so we did see that pull back a bit, but still above last year's lows. So a little bit of action in the fixed income market. That certainly helped returns because as again rates go down, values and bonds go up. But we look across the world, so the U.S. Pretty flat yield curve. Not a lot of incentive to go out 30 years when you receive roughly the same in the 15-year space. Looking at Germany, still beyond 10 years, they have negative yields. Not much movement there from the prior quarter, so still some negative yields out for a while there. Canada looks much like ours, as does the UK and Japan, but I think you'll notice that both in the US and Canada, as low as our rates are, they still look a heck of a lot better than some other countries. So let's look at the health of the market. So looking at the price earnings, so taking the price of the stock or the index over its earnings, you look at that first chart at the top there and you'd say it is somewhat expensive, and it is. It's more expensive than historic norms, although it's lower than the tech market crash back in 2000. But then in that lower chart, you'll notice that, but based on where interest rates are, it's somewhat attractive. So you look at the earnings yield on the S&P 500 versus a corporate bond, and you could say that it looks favorable still towards stocks. So looking at different metrics can give you different thoughts on where the market is at. Rates don't look like they're going anywhere. So, based on where corporate bonds are and the yield in the S&P 500, stocks look okay, neutral to favorable there. In the market sentiment, we're somewhat contrarian, and now people are very excited, very optimistic, and usually the smaller investor is wrong. So they're certainly very optimistic, as you'll see in the dark blue line there is above the average, pushing it towards extreme optimism, which is somewhat bearish for the market. The S&P 500, that dark line, that includes everything in the S&P 500. And then we look at the S&P 500 with its taking out, the top line is just the return on the FAAM stock. So that's Facebook, Apple, Alphabet, Amazon, and Microsoft. So they've cranked. They continue to do well. We had a little bit of a slowdown, but they continue to move forward. And then you look in the light blue in the middle there, that's the S&P with everything involved. And then you subtract out the FAM stocks, and it hasn't performed quite as well. So still, those top stocks are still big drivers of this market, and possibly will continue to be. This administration seems to be putting a little pressure on some of those areas, albeit we don't see any pressure yet on Microsoft, but we'll see where those goes. But they go. But at least at this point, they're continuing to catch a bid. Leading economic indicators, we've spiked back up above where we were when we went into the recession or the COVID slowdown. So those have come back nicely. Now, one factor to leading economic indicators, though, is ultimately the S&P 500. So as that's gone up, it's certainly helped those. But we're seeing the ISM manufacturing index. Manufacturing is getting better. So things are getting back online. So that is certainly a positive. And then you see the dark blue line at the bottom, the dip, 2020 to present. We're just starting out this business cycle, and one could look at this and say, well, compared to other cycles, we have some room to go, and we quite possibly do as we everything's opening up and we build out. Now, the good. Financial conditions remain very easy, meaning the Fed is still very accommodative. We had an inflation number the other day that was high, somewhat anticipated. The Fed is still saying they're going to remain accommodative. They pulled back the year from 2024 till 2023 before they potentially make a move, but it's still very accommodative. Manufacturing's picking up, retail sales from e-commerce, they kind of came back a bit, but they're still there. But we are seeing Americans traveling again. When we look at our consumer price index, as I said earlier, while the CPI number did spike a bit, when you break it down, you look at it, there's energy, used cars, and transportation that are really spiking there, and those are, as the economy starts moving forward, we would somewhat expect some of these areas to move up. So it could be, I think we're in the transitory camp right now. That could change certainly, but it looks like based on numbers like this that there's certain areas we would expect and kind of anticipate inflation would be higher. And then you look at the price volatility of industrial materials. It rarely, if ever, impacts the broad inflation, because there are blips or certain times when things happen, especially you look at recessions and coming in and out of recessions. But ultimately, in that kind of purplish line there, reddish line, you'll see it doesn't really ultimately have an impact on the long-term inflation rate. The Fed funds that I spoke of earlier, the Fed is looking to obviously switch possibly in 2023, but rates are still extremely low. Rates are currently low, and it's going to be a year or so out before they actually start playing with it. You can see in that squiggly line, the dark blue line, that's where the market is. So the market yield obviously spiked a bit there, but we've seen it come back. We tried to push the 2% level. We didn't quite hit it, and now today, we're at about a 1.3%. So let's wrap this up. We're still sitting on a substantial amount of money, not only here in the U.S., but you see it in Europe and in Japan. So there's a lot of money that the Feds of all these different areas have put into this economy. And when we talked a bit about last time, the 3 V's, vaccinations, vacations, and vast sums of money. So there's vast sums of money. You see that spike there, tremendous amount of money sitting in these economies. So let's look at the other V's there. We look at the savings rate, we look at corporate balance sheets, and it's still very high because of these vast sums of money. And then the vacations, these vaccines have led to people getting out, taking their vacations. We look at open table reservations, people are going out, they're eating, they're enjoying themselves, they're spending money. Same with airline volume. We're not back to pre-COVID levels, but we're certainly getting closer. We're starting to move forward. So we're seeing those things happening in this economy. Also, when you look at certain sectors of this economy, maybe say autos. So autos, a lot of auto sales right now. We saw that inflation number earlier where used car sales. So a lot of those sales were pulled forward, right? So they're maybe potentially giving up future sales because they pulled so much forward. But where we didn't see that, we've done a lot of adoption of technology, tremendous adoption of technology. However, we don't believe that has been pulled forward because there's still a lot of runway left in a lot of those areas. You look at e-commerce from 19 to 2020, but just look at the full capacity there. There's still a tremendous amount of room for e-commerce, telehealth, still a lot of room to grow there, streaming, digital payments, cloud computing. So a lot of companies are in a lot of those different areas, so we have a lot of runway in those areas. So some of those opening up trades, we would anticipate they slow down a bit because maybe we're going to at some point not be buying as much of those, which could hurt earnings, whereas some of these technology companies, we have a lot of room to grow. So implications in the market. one thing we're seeing a lot of is these companies are getting stronger. These companies are now, instead of acquiring other companies, doing other things like that, they're actually increasing dividends. And you see in that chart there, the purplish, blue, red line there is starting to move up. So that's projections as we go into 21, 22, and 23. So we'll continue to see dividends per share grow. When you look at different countries, so you look at the United States, there's 87 companies that have dividend rates higher than 3%, so dividend yields. There's even more in internationally, companies like Novartis, Unilever, so there's about 250, and then we see some in the emerging markets also, although some of those are country owned, but there's a lot of competition now for bonds, because if you're sitting in a 10-year treasury that's paying 1.3, or I can go out and get one of these companies, a Coca-Cola, Verizon, Novartis, that's paying 3%. I don't know. To me, that looks more attractive. Do I want to sit at 1.3 with really no upside, or a stock that pays me over 3% with some potential upside? So we're happy to see that, and especially because the long-term return, we like to look at total return. Sometimes people focus too much on what the potential growth can be, but sometimes people focus too much on what the dividend rate is. A lot of times people focus too much on dividend. They're looking at this company that pays a huge dividend, but maybe they don't go anywhere. But really what you focus on is total return, dividend rate plus the growth potential. So historically, dark blue is the increase in value of the stock, and then the light blue there is actually the dividends. So dividends that you're receiving, dividends that are reinvested. Dividends have historically been a big part of your total return. So if you said historically the S&P's done, call it 10%, well, in the past, maybe 4% of that has come from dividends. So for us to continue the market moving forward, where if you can say, well, maybe companies don't move up as much, if you start seeing an increase in dividend yields, the markets could continue to do well. So we're happy to see this. We're happy to see companies doing this. These companies tend to be better run. They don't want to lower their dividend, especially companies that have continually grown their dividend rate. So this to us is encouraging. So the implications to investment implications we see out there from everything I've just spoke of, interest rates, they're going to remain low for a bit of time here. We're looking at the Fed being accommodative. We're also seeing the market. The market is saying, okay, maybe inflation is transitory, because the bond market is certainly not pushing yields up. We did a bit last quarter, but in quarter two, it's come back down. Maybe they're saying inflation is transitory. Maybe they're saying this growth is transitory, because maybe they're saying, well, we don't believe in this growth. That could be something that could play out. However, rates appear to be looking low for a while. Inflation, there's a spike. We saw it in Tuesday's numbers. There's certainly there is a short term. There is demand in certain areas. We saw energy go up. We saw cars go up. And will it stay? Maybe, maybe not. Probably not in not in wages. Wages, if they continue to move up, those can't come back down. But other things will come back down. We see that in lumber. Lumber's down substantially from where it was at its highs. So some things are already coming back. So housing going to continue to be strong. There's really a lack of inventory. Rates are low. Not really surprising, because we didn't build a tremendous amount of properties after the recession 07-09. So there was a need for that building. All of a sudden the pandemic hits, and younger generations are now needing homes. So it's not a surprise that we have a supply-demand issue there. And granted, we're in California. Places are expensive, but at these low rates, they're still technically affordable. You can get a mortgage in the $1 million range, and it starts to compete with what rent costs for some people. So it is still technically affordable. The markets probably won't come down until real estate markets, until real estate is no longer affordable. And with current rates, things remain affordable. We're watching right now the rent mortgage moratorium that is set to come to an end. So what will that mean? What are the implications there? Will that now create situations where people have to short sell their house, or they have to sell their house, or there's more forced buyers, or there's more inventory there? We'll see. But right now, about 20 to 25% of all renters are behind in their rent. So it'll be an interesting thing to play out there. A lot of these people that own these landlords that own these properties will not receive that rent. So that all has to play out. Crypto has come back down. I mean, it was probably, Bitcoin's down roughly 50% from its highs. So is that because people are no longer bored at home trading it? Is that because of what gold is doing? Is now gold, people buying gold versus crypto? Or Is it because of China? Who knows? So that's something that's playing out. But we see that investors aren't purchasing it like they were in the past, or at least the appreciation isn't there right now. The rotation, earnings and dividends do matter, and I think we'll continue to see that. Growth stocks, technology stocks are still part of that. A lot of those companies have great earnings, and they're also quality earnings, and they're paying dividends. So I'm not saying you have to always look at value, because some of these technology companies I would throw into that rotation. Healthcare looks very well valued, meaning that it's attractive. Price to earnings are low. Companies like Merck have some nice dividends in the 3% range, and we're an aging population, so healthcare we think will continue to do well. And then earnings are pulled forward, so look in some sectors, maybe if you did well in some of the autos, some other areas, you may want to look at that and change that up a bit. So right now, we're not making really any changes in our portfolios. We're looking at our bond positions, making sure we continue to shorten our maturities, our duration in those portfolios, because right now, the bias would be in the long run for rates to go up, which could hurt valuations. Longer the maturity, it would hurt them more. So we're watching those areas. We're continuing to add to dividends because we think those sectors look great. So we want to thank you all for your time. And if we haven't reached out to you recently, we'll be talking with you soon. And thank you for your time.